All right, guys, Intel stock has had quite a year, up 26% year to date. I think its low recently was $24 or so. Now, Intel is a company that I own. So first off, don't go buying it just because I own it. This is a long-term turnaround play. If you want to own it, you need to understand the reasons why you're going to own it and if you're going to stay in it or not. Have I had my questions about Intel? Absolutely. Its stock has fallen precipitously. It is a big time loser. One thing I want everybody to see though, look at this. It has not recovered from its all-time high back in 2000. And I'll get into that more later, but in this video, we're gonna go over some bull and bear cases for Intel. Shocker, there are bull cases for it. We're gonna do some high-level metrics. We're gonna go over analyst estimates. Of course, we're gonna cover our 8-pillar process, and we're gonna finish it off with our stock analyzer tool, because you're probably wondering, okay, great. So what price do I pay for Intel? There are going to be some assumptions because, as we all know, the chip industry has gone through a lot of changes in the last couple of years. Revenue's fallen at pretty much every chip business, right, Mo? Mm-hmm. Yeah, there's been a big fall in revenue for the chip business. That's all great and dandy. But for this video, again, I want everybody to understand that we're going to go through things for beginners and all the way to advanced investors. No matter where you are in that spectrum, just remember there's something here for you. And if things sound confusing, it's okay. They will be. They were confusing for me. They were confusing for Mo. They were confusing for the 200,000 people who subscribe to our channel at some point. But you got to learn somewhere. Just keep listening, keep understanding, and we'll keep breaking things down for you. So, Intel. Again, it has not hit its high, all-time high of $75.81 back on August 28th, 2000. Now, a lot of people here who've not watched this channel, I brought up Intel up along with Cisco and other companies and saying is the example of it not hitting. Mo, you chuckled right there.
Yeah.
So
it's funny.
Some people might sit there and say, well, the company's gotten worse since then. Well, let's go back and look. In the last 12 months, the revenue is at $54 billion for Intel, which is off its high of $79 billion just a few years ago. And profit of, might be negative. Yeah, about $1 billion negative. But in the previous 3 years, they averaged about $20 billion in profit. All right. Let's go to 2000. They generated $31.83 billion and $9.4 billion in profit. So, from their all-time high in 2000 and now, forget about now. Let's look at the last 3 years. Revenue was at $74 billion, profit of $20 billion. So revenue had over doubled, profit had about doubled, and the stock has still not seen its all-time high. Why? Because this was overvalued. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. That is the key here. So what does that mean? It means whatever's popular in the short run is going to go up, and whatever's not popular is going to go down. But in the long run, as long as you pay a reasonable price for the business, the fundamentals are what's going to drive the stock price, very simply. But it's hard as an investor to sit there and to navigate that world of seeing everybody see a stock go up and not jumping on board and seeing a stock plummet and say, I'm ready to buy. That's a very tough thing to do, especially with so much news out there that could be positive or negative. Because remember, news follows the stock price, not the other way around. So when a stock is going up, the news that justifies it going up is going to come to the forefront. When a stock is falling, the news that's going to justify its fall is going to come to the forefront. So Intel is now a $139 billion company, $54 billion in revenue. Some things here, gross profit margin of 38%, which is lower than it has been in the past. Historically, it's around 40%, 44%. And profit margin, look at that. It's currently negative 1.7, but historically is in the low mid-20s.
Yeah, so you're going to notice here that there's a lot of things that are probably skewed because it's been a rough 2 years.
So this is definitely a turnaround play.
Yeah.
And for myself, apart from something major changing that turnaround play where I sit there and say, listen, this is not going to work at all, I still think these factories they're building in Columbus, Arizona, and Germany have a lot of potential. And we're going to see that in the bull cases. They have gained some market share. Mm-hmm. So Mo, why don't you go over some bull and bear cases on Intel right now? That way our viewers can see how dumb we really are.
Okay, so I'm going to use some terms here where I read this and I go, what the hell is that? So you're going to probably do the same thing. As of August 14th, 2023, 68.5% of their x86 computer processors, 68.4% of those are them.
Okay, which doesn't mean much until you tell us the next point.
Yeah. So Intel has gained market share over AMD in that chip from 77.5% to 82.6%.
Now, that's the big thing because AMD is supposed to be the one that's
They're supposed to be the one taking market share away from Intel.
Correct. And this is a big chip for them. And listen, there's a lot of promise there on that. One of the things also that Intel has is they're their own foundry. They make their own chips, and they used to actually make other people's chips. They still do.
Well, that's the goal of everything they're doing now.
Yes.
Become more of a foundry for Taiwan Semiconductors, AMD, et cetera.
All these people, they want to make, so a foundry is the one that makes the chips, right? So they want to sit there and be like, hey, listen, we'll just make your chips for you. You can compete with us.
We'll make ours and we'll make yours.
I'm fine with that. We'll make money off that both ways.
That's the big bet that they're making.
Yeah. So anyhow, what's some other cases you got here?
So those are the bulls. Bears, there was a $5.4 billion acquisition of Tower Semiconductor. That fell through.
Just last week.
Yeah, actually, if you go to their website here, it's their latest press release, August 16th.
Do they provide any information on why they did that?
I can go in and read. So we have in here is Chinese regulation and delays were slowing it down. I'm not sure if that's exactly the reason, but I could figure it out.
Mutually agreed to terminate its previously disclosed agreement to acquire due to inability to obtain in a timely manner the approvals. There you go.
Intel will pay a termination fee of $353 million to Tower.
Ooh, wow.
Yikes.
That's a lot of money.
Yes, it is. Okay. All right.
Another bear case.
Yes. Total addressable market for servers is expected to fall 17% year over year in 2023, while the AI server market is expected to grow 40%.
Well, of course AI is going to grow. AI it's still in its infancy, and it's going to grow.
I think it's good that, like, sometimes I read these bull and bear cases, and you're like, well, that's dumb. That's obvious. That's the point. That's why when you look at some of these cases, that's why we put obvious ones in here to make you say, oh, well, that doesn't really mean much. That's very short-term looking. That's the point.
Yeah.
I want you guys to see that not every bull and bear case is set in stone. Some of them are just like nonsense.
And guys, what we want to hear from you is if you have any bull and bear or any bull or bear cases that you want us to know about, mention it in the comments below. When we make our next Intel video, we're going to go back and see what comments were liked the most, and we'll give you a shout out. We will sit there and we will comment about it. But remember, just because a piece of news is there doesn't mean it's material.
Correct.
That's the hardest part about investing. When I hear people say to me like, Paul, I don't get why you like this company. Their margins have dropped 17 bips. I'm like, okay. We can make a case for everything. Just like on the way up, people say, oh, this is the future. Great. You can still overpay for a good thing and underpay for a bad thing. I don't think necessarily Intel's a bad thing, but I wondered to myself, do I really think Intel's going away? I don't believe so. So right now they're in the reworkings, and hopefully these big investments in these factories will really turn things around for them.
Yes.
All right, so let's go over the 8 pillars here real quick. It's probably going to be ugly. Oh,
Yeah.
It is ugly.
So these are also probably skewed.
Now, guys, remember, if you have our software, you can customize your pillars up to 12 different pillars, 4 quadrillion different variations, and we're adding more as we go. So, guys, 5-year PE is down a lot. Now, they made a lot of money in the previous 4 years. Last year, they lost money. 5-year price of free cash flow, it's okay, but that's not great. 20.86. I would hope it'd be lower for how this price to earnings ratio is. They've bought back some shares. Okay, fine. By the way, I believe Pat, what's his name? The CEO, has bought some shares lately for his trusts of Intel. Remember, guys, when people buy shares, they buy shares for one reason: to make money. When they sell shares, they sell shares for 1,000 reasons, as Monish Pabrai said in our interview with him, and he's right. You can sell for diversification purposes, for estate planning, to make a big acquisition, etc. But when you buy shares, you're only buying shares to make money. Now, is that a material purchase? I don't know.
So in 2020, they issued a $20 billion buyback program, and they've suspended it since.
Okay.
But
and that was when the stock was much higher than it is today.
Exactly. I mean, that's when it got to its last high before 2000. It was like $69 and change.
Wowzer.
Yeah. Still didn't get to $70, which is amazing.
That is amazing.
Yeah. So, all right.
Okay. So, this are the 8 pillars. A skewed ROIC. They're spending a lot of money right now. The industry has dropped in revenue. Every single chip manufacturer has seen a drop in revenue. I am kind of surprised about Intel's, but we'll see what happens. Net income growth collapsed. Free cash flow collapsed. Everything here says bad stuff. This is purely a turnaround play. Purely. That's all you're looking at here. That's it. Now let's see what analyst estimates are saying for the company.
These are going to be all over.
They're expecting, there's 45 analysts right now who are expecting the company to make 64 cents a share. Now, guys, this is the turnaround play. Look at the increase that they're expecting in Intel over the next 4 or 5 years, from 64 cents a share to 424. Now, right now the stock's at 33. If it makes 424, you're talking about 8 times earnings 4 years from now. You know, a lot of companies we have are like, oh, look, it's 25 times earnings 4 years from now. This is 8 times earnings. But again, these are analysts. I don't know if they're going to be right or wrong. I think for this, it's more of a play of, do you believe Intel will be around in the future, and will they still be a big player in the chip industry? That's the question you have to ask yourself. Now, I will say this. I want to compare some of these metrics to like AMD. So Intel's market cap's 139 billion with revenue of 54 billion. AMD is 175 billion with revenue of 21.9 billion. So 60% less revenue, but more market cap. Again, my play on Intel is, all right, if I think Intel's just going to go from here and be normal growth, so their revenue dropped 30%, but they stabilized from here and grow at a normal pace, let's go see what that means, right? Because that's really what matters here. Let's look at revenue growth estimates guys, look at this. They're going back to record revenue in the next 3 or 4 years, according to analysts. And again, you have to take them for what they're worth. They're still analysts, but everybody's crapping on Intel, and there's still big assumptions for the future. I don't know. My bias is here clearly because I own the stock, and again, don't buy the stock because I have it. This is a long turnaround play. It is probably the most criticized stock that I have.
Probably. People
say like, oh, Paul's an idiot, he bought Intel. Okay, then I bought Intel, and I was an idiot. That's fine. But I look at this saying, I'm comfortable for myself, dollar cost averaging on a company that I think will be around for a long time. All right. So this leads us to our question. What price should we pay for the company? Now, guys, this is our stock analyzer tool. This is what I use. Mo and I use it every single day to determine what price to pay for the company. Now for Intel, as you can tell here, big time revenue growth dropping and profit margin negative. What I'm going to assume here on these numbers is more stabilized from here. Okay, this is their bottom. Let's see how they can grow from here. I'm going to make low assumptions, middle assumptions, and high assumptions, okay? That's the big key here. This is what makes investing an art. You have to make assumptions. If you have different assumptions than me, I'm great with that. I'd love to hear about it. Put it in the comments below because we want to hear what assumptions people are making. But Intel is a difficult situation we have to figure out here by doing assumptions. I'm going to ask Mo for his assumptions, and my guess is we'll probably have a pretty involved conversation here. So please stay with us throughout the end of the video to talk about these assumptions. And guys, if you like this, if you'd like the idea of this, if you'd like all of our tools that are available here in our software, there's 7 or 8 tools, plus our community, and we have data coming in, new data coming in every single quarter. Sign up now, everythingmoney.com. We have a special 20% off right now. It's about $1 a day, guys. So again, everythingmoney.com, 20% off. Mo, give me your revenue growth numbers over the next 10 years for Intel. Give me low, middle, and high, and I think they're going to be wide-ranging. So what do you think?
I was thinking 3, 7, and 11.
Okay, what were analyst estimates again for the next 5 years?
Probably about that 11% range.
All right, so at 11% for the next 10 years.
I can get my reasoning behind each number.
That's going to take them to $150 billion in revenue in 10 years. That seems aggressive. But if they crush it with these foundries...
That's my thing.
Exactly. That's the reason Mo put a big number in here. And this 3%, I was actually thinking to myself 3, 6, and 9, but I like 3, 7, and 11. Because I do look at 3% saying, listen, let's just say this is the new company and it's going to be boring and they're going to grow 3 or 4% a year like the world grows. Because remember, the chip industry is expected to grow 10 to 12% a year for the next 10 years. So 3% is not a lot.
Yeah. And 11 is they dominate that foundry industry.
Correct. All right, profit margin, Mo.
So I was thinking 20, 23, and 26.
I was actually going to be a little bit more negative.
Okay.
I was going to go 18,
okay,
22, and 26. Because even in their normal times, they were still making 23, 24, 25%.
Okay.
So I'm looking at this going, you know what I'm going to do, Mo? Can I veto your 7? Can I go 6 here? But we'll keep the 11 still.
Right.
But can I go 6?
Sure.
Because here's the reason why, Mo. On the revenue growth, guys, I just changed the 6. I think 7's still a little aggressive, but I think 6 is something that
is achievable.
Very achievable, but not crazy. Exactly.
Yeah.
Like if they just keep their brand name, stabilize things, I think they can grow that 6% revenue. And it's still almost doubling their revenue in the next 10 years.
Right.
All right. What about free cash flow margin, Mo? It's been heavily skewed lately because of their major capital improvements.
It has. So for that reason, I'm going to put in the same numbers as the profit margin.
Okay. So even though, guys, if you look here, free cash flow is a lot lower than than historical. Over long periods of time, especially with these big investments being made up front, this should even itself out. So I'm hoping, we are making assumptions here, but let's just keep it. A lot of times we like to keep the free cash flow and the profit margin exactly the same. Now for PE, guys. Now, PE is a tough one. What we like to do is we start at 15. That's the market average over long periods of time. We go up if there's a high ROIC, high growth rate, or a moat. We go lower if the opposite occurs. So Mo, what do you think here? This is a tough one because look at their ROIC. It is declining. Guys, ROIC is the return on invested capital. That's the return they get on the money invested in the business.
I was thinking 15, 17, and 20.
See, I think lower than 15 as a low.
Okay. I would be fine. I
about
just think
13?
that 20 needs to be on the high end.
What about 13, 16, 19? Or do you want to do 20 on that? Do you
So
want
I
to do?
always say 20 on the high end because if they really do become a foundry and it's the go-to place.
Okay. Then that's serving a premium.
Yes.
So I just did 13, 16, and 20.
Okay.
Okay. For both price to free cash flow and
Yeah.
price to earnings ratio.
Right.
Now, finally, guys, our desired annual return. This is our margin of safety. The higher our assumptions, the more margin of safety we need because it's less likely to occur. The higher your desired returns, the lower the stock price. That's what drives the stock price down. If you want to make more money, you got to pay less for the stock. So if you can get 9 or 10% from a long-term ETF, Mo, where should we put the low, middle, and high in desired return? And I think this is a turnaround play, so it deserves a higher return.
Yeah. So on the low end, I think 10% is fine.
Okay.
Don't you think?
It is pretty beaten up on the low end.
Yeah.
So this is assuming it just stabilizes. Okay, so what about the middle and high?
How about 13% in the middle and 16%? Actually, you know what? Maybe 17% on the high.
Okay.
Because I do think, like, this is a big bet. This is
This
a really big bet.
Now, guys, I just hit the analyze button. The stock is currently at $33.37. Stay with me for just one more minute. And remember, if you like the software, you like what we're doing here, it seems intimidating, but guess what? It's a lot easier. People in our community are always sharing their assumptions, saying, what do you think? Sign up, everythingmoney.com, 20% off. Now, guys, a lot of numbers are going to pop up here. Stay with me one more minute. We're going to explain them, but I hit the analyze button. Let's scroll below. A low price of 30, a high price of 63, a middle price of 43. If you paid today's price and your low assumptions occur, you're going to make about 8.84%. If your middle assumptions occur, you're going to make about 17%. If your high assumptions occur, about 27%. So if our high assumptions occur, we're going to crush on the stock over the next 10 years. But again, guys, you have to be ready for volatility. I wouldn't be surprised if the stock went to 20. In fact, I'm expecting it to, and that's whenever I buy a stock, I expect it to go lower, and I expect the dollar cost average as long as my thesis stays the same. That's the big key. Guys, thank you very much for your time.